We're going to go over Palantir Technologies, ticker symbol PLTR. Over the course of the 1 year, this company is up 105.8%. Year to date, this company is up 138%. We're going to go over the most recent earnings statement, the 8K, and then we're going to move over to the valuations and come to a fair market value price and also a potential 30% margin of safety price on Palantir. Right after that, we'll look at the stock chart and see if we can't maybe determine where price action might be headed next for Palantir. We're going to begin at the income statement here. We have over here 6 months ended. We've breached the 1 billion revenue mark. Year over year, only up 13.2%. Their gross profit grew more than their revenue in percentages, up 14.4%. That's always good to see. Total operating expenses up only 3.3%. That's pretty good. And in terms of the percentage increase here, we had sales and marketing, research and development both increased, which is good, which could typically lead to more revenue. And our general administrative has decreased. So nice to see there. They basically eliminated, some potential jobs or whatever, which, obviously not always a good thing to do that. But as a investor or shareholder, you kind of want more money in your pocket, not, more flowing out. But so anyway, so they eliminated some jobs and took that money and put it into these two by the looks of it. So pretty solid. I like to see that. Interest income on the capital they have invested in marketable securities. They made $51 million on that. Down here for an income, um, we are positive because of their interest income. We can see $844 million. Most of that was soaked up from operating expenses, which left us with $14 million. So basically 14, 51, then minus these two gave us 51, just shy of 51 positive $1 million for this most recent 6 months. So after income taxes, it gives us $47 million net positive. Share count here, we see a pretty big increase in total amount of shares. It's like 207 million in total increased share count, which gives us 9.2% dilution, which that that's not good. Share-based comp here, 229 million they paid out in share-based stock-based comp. Total current assets. This company has 1.05 billion in cash. We can see that last year we had 2.6 billion, so we want to know, okay, why did we lose 1.6 billion? Where did that money go into? But we can, next row down here, we can see we went from 35 million to 2 billion in marketable securities. So 1.6 of that went into here, plus a little more. So we'll see where that other money came from. It probably came from somewhere on the cash flow statement, which we'll get to shortly. Um, Accounts receivable, we can see increased. So if this company acquired more customers, this is a good thing. If not, this could be bad. If this keeps rising, if they're not getting more customers. If they're getting more customers, then this is fine. This is good. But if they're not acquiring more customers and this number continues to increase, then their customers are not paying their bills, and Palantir is potentially lending to companies that aren't credible. So just something to keep an eye on as this increases, unless they state like, hey, we have increased our customer count to X numbers. We grew it like 10%. And then if you see this increase, then okay, then that's okay. That makes sense. So we see here a reduction in our property and equipment from 69 down to 54. This could be a reduction or reduced because of depreciation, which there is a reduction or a depreciation increase on the cash flow statement. Accounts payable, money owed to creditor or supplier. So we can see we went from 45 down to 46. So this is a liability. So this is going to, since we paid off a debt on the cash flows, this is going to show up as a negative because money flowed out of the company. Accrued liabilities, this could be from, payroll, or they owe another business or money for goods or services that was provided to Palantir. And as we can see, it increased on liabilities, so we'll see an increase in cash flows on that side of things. Deferred revs, unearned income increased of 77 million. This decrease will show up on the cash flows. So as this number increases, cash flows will increase as well. Next up, customer deposits, we can see also increase. So we'll see that as a positive, like 41, 42 mil increase on the cash flows. Next up, we have, so total, we have $685 million in short-term debt. And if you kind of dissect through this, the only really things that are true debts to this company is its accounts payable and accrued liabilities, and you could probably throw in lease liabilities if you wanted to as well. So you're talking $250 million really, not even in short term, $240 million in short term debt. These other things are just unearned income, accrued liabilities, and or sorry, deferred revenue and customer deposits are basically just money waiting to be raked in. I mean, they've been paid already, but they just got to provide the services. So next up, we can see that 685 million in short-term debt, deferred revs 50, customer deposits again, and these are longer term, must be longer term contracts possibly. Operating lease liabilities, we have just shy of 200 million in operating leases, and then other non-current liabilities of $12 million. So again, same thing here. You're talking just over $200 million in long-term debt. So combined, you're talking less than $500 million in total long-term debt of actual true debt on this company. And they're sitting on, $3.1 billion in cash. That's solid. So this company's got, it can pay its debts and still have plenty of money at the end of the day, which obviously it's probably done already. So overall uptick in debt is from deferred revs. Actual debt is almost zero. If they deliver on all their deferred revs tomorrow, this liability statement would be almost blank. So their stockholder equity, we can see here, went from 2.5 up to 2.9. So always good to see an increase in stockholder equity. Down here to cash flows. So we brought our 47 million net income down to the cash flow statement. We can see here we have our depreciation that we talked about on the plant, property, and equipment. So there's about 15 million. So there could be a amortization of some kind somewhere else. Obviously, it's pretty nominal at that point. So stock-based comp, we saw they paid out 229 million. So this obviously shows up as a net positive in cash flows. They have an unrealized loss or potential realized loss on marketable securities of 11 million, and this loss shows up as a positive on cash flows. They took that loss somewhere else. A lot of money being moved around in their marketable securities, so it probably got buried in there somewhere. Accounts receivable, we saw the accounts receivable on the balance sheet. We saw that increase on the asset side, so we're going to get a decrease in our cash flows. We have accounts payable, same thing. Majority of this whole section here is all going to be on your liabilities. And we're going to see most of those flow over to here. Either if they're positive on liabilities, they're going to be positive here. If they're negative on liabilities, which means if they went from a higher number to a lower number on liabilities, that means money flowed out of the company, and that means cash flows went negative, or that part of the cash flow is a negative because money went out. Overall, we now have cash provided by operating activities of $277 million in the last 6 months. We have $8 million in CapEx, gives us a $269 million free cash flow and annualized $540 million. As we saw on the balance sheet, they bought liquid investments with excess cash of basically $3 billion here. They made 948. They probably reinvested that 948 into this because we saw about what, a $2 billion increase. So that $2 billion says 948 would equal that other chunk here. So they reinvested their proceeds from sales and redemption of marketable securities. So overall, that gives us a loss sort of a reduction on cash flows, or a cash and cash equivalents of $1.9 billion. They had proceeds from exercises of, so common stock, or from options, I mean, They increase that got increased as well. So now there's even more share dilution there. So now we add that in because that is now more cash for the company. And then we get 1.155 was because we take 277, add it into that, and then you add into that, gives us 1.55 negative in total for increase or decrease in cash and cash equivalents. In this case, a decrease. So we started with 2.6 billion, and now we're left with $1 billion in cash and cash equivalents at the end of the period. So a few company statistics here. We have return on equity is negative. We want to see 15%. Return on invested capital, negative 2.4. Also want to see 15%. Gross margin is very nice at 79%. And mind you, all these numbers are trailing 12-month numbers as well. Operating margin, -3. Profit margin, -2. Share change year over year, sitting at 10.87% positive. That's really bad. Analysts have a price target of this at $13 per share. We have 13 analysts averaging out to $13 per share. Gives us a 14% price difference. Now we're trading at 15.21. Analysts have a 23% revenue growth rate in the next 5 years for an average. Also down here we can see a little bit of a breakdown of the next 3-4 years. We've only got analysts up really up to the next 2 years, up to 2025. Revenue growth 18, 18, 22, 36. So they're expecting, well, I wouldn't consider this real, but they're expecting this to be about a 20% revenue growth company in the next few years here. Earnings per share, same thing. They're sitting 19, 30%, so mid 20s for revenue growth, 25%, or sorry, not revenue, but earnings per share growth. Our Peter Lynch valuation, PLTR, our current return on invested capital is negative 6.7%. So because we are a negative earnings per share, there's only going to be a few valuation methods that we'll be able to base our price off of, our valuation. So Peter Lynch fair value is going to be negative. Our multiple comparison is also going to be negative. Our manual PE, we can take a look at. We can see our market cap is $32.7 billion. Cash and cash equivalents, 3.1. Debt, 945. Cash from operations, 558 annualized. So we take and see that it's going to take 54.7 years before this company grows into its current market cap. So if they can increase their cash from operations from 558 to, let's say, $1 million, you can see that almost cuts their years to valuation in half. So if they can manage to do that in the next, you know, and this is after 1 year too. So if they can get a cash from operations up from 277 per 6 months to maybe 300 or 400 per 6 months, or 500 would be great, then that would put them at a 30-year multiple like that, and that would get them much closer to a better fair value price. So at this point, based on this calculation, we want to see them grow into what they are trading at for sure. Price to book, they're currently trading below their 5-year average price to book. Their forward-looking PEG ratio is very, very richly valued at 2.9. We want to see 2 or less. So they're up there at the moment. So that analyst price range target of like $13 per share is probably pretty close to a decent price to book ratio there. Because we're negative earnings per share, again, Graham's valuation will not compute for us. Weighted average cost of capital, 17%. 2.5% growth rate. Future free cash flow of 15% growth. Cash from operations, as of 2021, we started turning free cash flow positive and have sustained that so far. Our average growth rate was 13.5%. Analysts are projecting 25%. I put 15% in there. I prefer to be a little more on the conservative side than picking the highest number. That gives us a terminal value $3 billion. $3 billion. Gives us a discounted cash flow price per share of $1.84. Rule 72, I used the future forward-looking earnings per share and PE. Forward-looking in the next 12 months is 22 cents earnings per share. Current PE would be 67. We had two different growth rates, 25 and 82. Obviously, I used 25. 25 goes into 72, 2.88 times. 2.88 goes into 10 years, 3.47 times. So between 3 and 4 here for doubling our earnings per share gives us a future earnings per share of $2.60. Fair value is then 32.44 with a 30% margin of safety of 22.7. So that gives us down here our average between our fair value and discounted cash flow is $17 per share, 30% margin of safety of 12. So the 30% margin of safety just below analyst expectations. However, $17 is above. Also, however, we have only got two valuation methods working for us. So always a little cautious when only got two of them versus having six or five different numbers involved. The good on this company, basically no debt. I mean, we went through that. There's like $500 million in debt, and they've got 3 billion, 3+3.1 billion dollars in just cash. So they've got way more than enough cash to sustain themselves and use that cash to for something. I think they need to start doing that, whether it's share buybacks or, something. They're starting to turn positive. I think they can start using that cash for something else besides just sitting on it. So they have lots of cash that can be put to use, invested most of their cash into securities to earn interest income. Always good. CapEx has decreased. Our operating expenses only increased 3.3%, and for all good reasons as well. The bad company is only cash positive because of their investing activities. Once they can start hopefully turning a positive on the actual heartbeat of the company, then I think that would be huge. Still significant amount of share dilution going on. They increased their share count by 9.2%. Growth rate in the past 6 months hasn't been good for the growth of the company, sitting at 13.2 increase in revs, 14.4 gross in profit. Return on equity and return on invested capital are both negative. Normal for a growth company, but still want to see those positive. In my opinion, overall on this company is a bit lackluster. Nothing very. The only thing that really caught my eye was their debt, their balance sheet overall. Very solid balance sheet. Um, really, I mean, the financials overall are pretty solid. So they are using their cash to earn interest, which we've talked about already, but I think they could use that cash to acquire more businesses or increase revenue, some figure out a way to get yourself to that positive revenue side of things. And then this company has got a lot of upside potential to it once they can start figuring that out. Over here in the stock chart of Palantir, we're on a daily chart. Um, we've kind of we've obviously broken this downtrend. We are now in this bit of an uptrend here. We're sitting on a support range, and there's also a resistance range here at like $19 per share. So currently, company we know is probably trading at a bit of a premium based on the calculations that we got and analyst expectations about $13 per share. Here's where that's sitting. So right now we're trading at about a 15% premium on the price, depending on what valuation you look at it. If you want to average out the 17 and 13, then you're sitting at about about a 15 there in terms of fair market value, which is exactly where it's trading. However, if this does pull back down to this trend line, might be a good buying opportunity for Palantir. There's nothing that scares me on the company. It's just, it's growing, it's figuring its thing out and kind of going from there. So overall on Palantir, pretty decent. I think it's richly valued right now. I think if it pulls back to like, the 10-50 range, I think it might be a good buying opportunity there. But overall right now, I think it is overvalued and could use a bit of a pullback, but solid balance sheet, financials look good. Might be worth looking into the fundamentals, the other side of fundamentals a little bit more, like the news and the company's forecast and stuff like that, and see what's happening over there on that side of things too. But again, if you guys found value in this video, consider liking and subscribing, and we'll be back again with another stock analysis video.